Welcome to this explainer. Look, if you're operating or managing finances in the Indian hospitality sector, you already know statutory compliance is basically a giant puzzle. Today, we're setting the stage to untangle India's incredibly complex dual taxation environment for hotels. We're going to break down the indirect tax mechanisms of GST and the direct tax withholding obligations of TDS and show you exactly how these two systems interact.
Picture this. Your hotel just hosted a massive corporate banquet. You send over the bill, and suddenly, boom, you realize a huge chunk of your revenue is trapped in withholdings. Why? Just because of a simple formatting error on your invoice. Seriously, how does a single, unitemized invoice trigger such a massive cash flow drain? Or, think about this. How could bumping a room tariff up by literally just a few rupees for one night permanently change your food and beverage tax rates for an entire year? In this explainer, we're going to look at the incredibly high stakes of misclassifying corporate stays, room tariffs, and restaurant bills.
Okay, let's dive right into this. To give you a clear, structured roadmap today, we're covering 5 key areas. First, the hotel tax labyrinth. Second, decoding GST tariff tiers. Third, food, beverages, and bundles. Fourth, navigating the TDS minefield. And finally, strategic billing and compliance.
All right, starting off with part 1, the hotel tax labyrinth.
So to survive regulatory audits, you absolutely need a precise operational understanding of your transaction values. The reality here is that hoteliers face this really complex dual taxation system. On one side, you've got the indirect tax framework, the goods and services tax, or GST, right, which you collect and remit. But then on the other side, you face direct tax withholdings, TDS, which your corporate clients actually deduct from your payments under the Income Tax Act. Now, confusing the mechanics of these two systems, or even worse, failing to align your revenue management with your tax compliance, well, that frequently leads to severe margin erosion, heavy penalties, and completely lost tax credits.
Moving on to part 2, decoding GST tariff tiers.
Let's reverse engineer the GST code for dynamic pricing post-GST 2.0. There are 3 distinct tiers, and they break down based on the actual transaction value billed per unit, per day, not that old printed rack rate. First up is the exempt tier, for tariffs up to 1,000 rupees a night. That's a 0% GST rate, but, and here's the catch, there's no input tax credit or ITC available. Second is the concessional mid-tier, for rooms between 1,001 and 7,500 rupees. This demands a mandatory 5% GST levy, but crucially, ITC is completely blocked. Finally, you have the premium tier for rooms above 7,500 rupees a night. That attracts an 18% GST rate, but it actually allows for full ITC eligibility. The main takeaway, your pricing literally dictates your ability to recover taxes paid on your operational expenses.
And this brilliantly illustrates what we call the mid-tier margin squeeze. Since that 5% slab strictly bars you from claiming input tax credit, it essentially creates a massive trap for mid-tier properties. I mean, think about your high-cost overheads for a second. Commercial laundry, property maintenance, security services, and of course, those hefty OTA platform commissions. The GST you pay to these vendors becomes an absolute unrecoverable operational cost. You're left with a tough choice. You either absorb these tax costs internally, which totally erodes your margins, or you bump up your base rates, which chips away at your competitive advantage.
But here's the thing, rooms are rarely sold just as rooms, right? Hotel billings frequently bundle services together, and this is where GST law makes a critical distinction. First, you have a composite supply. This is naturally bundled. Think of a room stay that includes a daily breakfast buffet. In this case, the entire bundle is treated as accommodation and taxed at the room's tariff rate, whether that's 5% or 18%. But if you offer what's called a mixed supply, which is artificially bundled, like say a room package with independent spa treatments, the entire package attracts the highest tax rate of the individual services. For a spa, that bumps the whole shebang up to 18%, which is a seriously costly mistake if you aren't prepared for it.
All right, let's look at part 3, food, beverages, and bundles.
Food and beverage taxation in hotels is honestly a unique beast, and it's heavily anchored to your room classification. So let me pose a quick question to you. Can one single high-value booking change your tax status for an entire year? Well, the short answer is absolutely yes, and it's actually one of the most dangerous tripwires in hospitality tax compliance.
Let me introduce you to this concept of specified premises. Standard hotel restaurants operating where room tariffs are 7,500 rupees or less, they charge a uniform 5% GST without input tax credit. However, a property becomes a specified premises if it crossed a specific line in the preceding financial year. Listen to this. If you supplied even one unit of accommodation exceeding 7,500 rupees per night last year, boom, your internal F&B operations are automatically elevated to an 18% GST tier with full ITC for the entire subsequent year. Think about that. If your revenue management team bumps up a room rate for New Year's Eve just once, without telling the tax compliance team, you risk undercollecting GST on all your food and beverage sales next year. You'd be charging 5% instead of 18%, literally setting yourself up for massive audit penalties.
Let's see how this plays out when we bring e-commerce operators, or ECOs, into the mix. Think food delivery platforms like Swiggy and Zomato. Normally, for standard hotel restaurants, the statutory liability to pay the 5% GST shifts entirely over to the delivery app. The platform pays it, no ITC involved. Simple. However, if your hotel happens to be a specified premises, that exception goes right out the window. The hotel remains legally liable to issue the tax invoice, collect the 18% GST from the consumer, discharge the tax directly, and claim the eligible ITC.
That brings us to Part 4, Navigating the TDS Minefield. Now we pivot to direct tax withholding, and specifically we're exploring the nuances of corporate bookings. Section 194I of the Income Tax Act dictates TDS on rent. Now for hotels, this applies when accommodation is taken on a regular basis. If a corporate client legally binds you to earmark specific rooms for them continuously, you trigger a massive 10% TDS deduction. That is, if the total payments exceed 240,000 rupees a year or 50,000 a month. But actually, scratch that. Here's the key distinction. If you simply have an agreement establishing a discounted rate for ad hoc casual employee stays with zero guaranteed inventory, it falls completely outside Section 194I, meaning zero TDS deduction is required. Now, what's really interesting when we break this down is how clearly it maps out exactly which TDS section and rate applies to different booking scenarios. It really highlights the distinct tripwires. As we just saw, ad hoc stays are excluded at 0%. Long-term earmarked stays, they fall under 194I at 10%. But look at standalone banquets or pure catering. These are considered work contracts under Section 194C, which triggers only a 2% TDS rate for corporate entities. And finally, if a booking is facilitated by an online travel agent or OTA, while under Section 194O, they have to deduct 1% TDS on the gross amount facilitated through their platform. Finally, Part 5, Strategic Billing and Compliance. Let's bring GST and TDS together to synthesize a strategic solution, because at the end of the day, how you bill determines how much cash you keep. Remember the hook from the beginning of this explainer? The unitemized invoice? This is what I call the composite trap. When hotels issue unitemized composite bills for a corporate event, combining room stays, food, decor, AV equipment, corporate accounts departments are legally obligated to deduct a staggering 10% TDS under Section 194I across the entire gross invoice value. That is an accidental, massive cash flow drain on your catering and event revenue. So what's the solution? An itemized invoice. By splitting out the charges, the earmarked accommodation gets the 10% TDS, sure, but the food, catering, and equipment get billed as a separate service contract. That drops the TDS on that specific portion down to a much more manageable 2% under Section 194C. A real game changer. To really protect your margins, your front office and finance teams need actionable operational strategies. First up, dynamic tariff monitoring. You need to audit your room transaction values daily to track that 7,500 rupee threshold so you don't accidentally trigger specified premises status without even knowing it. Second, POS line item isolation. Go in and configure your billing systems to unbundle composite packages, making sure 5% non-ITC food services are clearly separated from 18% ITC-eligible ancillary services. And third, implement strict split billing protocols for corporate events to completely prevent those unwarranted 10% TDS deductions on your catering.
I want to leave you with this final, vital thought. Revenue management and tax compliance can no longer operate in silos. A single isolated pricing decision by your sales team can fundamentally alter your property's tax destiny for the entire year. So ask yourself, if an auditor walked in today and pulled your last 5 corporate banquet invoices, how much of your margin would instantly disappear into the withholding trap? Thanks for joining me on this explainer. Take control of your compliance before it takes control of your cash flow.